Good morning, everybody. Nice to sort of see people in our new world. We're adjusting and really happy to be here at the Milken group and with this special, really fascinating panel. I'm excited to introduce them. We're going to get right into it. It's a session about how the hedge fund industry is dealing with volatility, looking for alpha, looking to make money, and sort of adjusting to this unique world. And I thought we'd get right into it. First, let me give you just a quick introduction, very brief. I've been asked to kind of keep a brief introduction. You can look in the bios to who everybody is. But Mala from Lone Pine, one of the most distinguished hedge funds out there. Panayiotis, who's an allocator and a large one. They've got $29 billion there in employees, retirement system of Texas. Morris Mark, a veteran in the industry. Many people know him. Not many people know. I was a Harvard law grad. I didn't know that myself. And Ricky Sandler, also well established, $7 billion interesting hedge fund. So I'm looking forward to hearing everybody's thoughts. So let's dive into it. Everybody on this panel is a bottoms-up type investor or allocator, and yet we're in a world where you can't ignore macro investing, macro environment. We have an important and contested election coming up. We've got a pandemic that we're dealing with, all kinds of other important macro factors. So given all that, I thought I'd start off with Ricky asking which of these sort of macro factors is impacting your investments and your process, and in what way? How do you as a bottoms-up investor deal with these kind of macro challenges?
What's interesting and maybe a little weirdly perverse is that the macro issues actually are so big and so large and so varied. And when you couple them with sort of quickly changing micros as the pandemic rolls through, actually none of them are significant enough to stand alone and make sort of a high conviction investment. And so in a weird way, we have not been overly focused on any of those issues as single issues, and it's actually allowed us to sort of focus more on the bottoms up. Obviously, each of those macro issues does affect how things play out, but when you look sort of broadly at the things we think about, they're all sort of pointing to the same thing, which is an improving and frankly very strong economy. If you look at the pandemic and what happened to consumers during the pandemic, in one of the worst sort of quote unquote recessions we've ever had, actually consumer incomes accelerated to the upside because government transfer payments more than made up for whatever was lost in wages. And frankly, at the same time, consumer expenditures plummeted because of all the restrictions. So consumers built up an enormous balance sheet of savings and enormous pent-up demand. And we calculate that the excess savings over the last 6 months has been about $300 billion. That went into consumers' pockets. That's about 2.5% of yearly consumer spending. And so if that gets spent over the next 12 months, forgetting about any incremental stimulus that we may get, that's going to add 2.5% to consumer spending, and that's 70% of GDP. So I think the backdrop is pretty strong, quite frankly. On top of that, we have obviously wide open credit availability and capital markets. We have some pent up demand. We have a really strong housing market. And slowly but surely, we will get through this pandemic over the next 9 to 12 months. And so things will open back up even more normally. So I think the overarching view is, despite all these things, even with a Biden victory, it doesn't seem like his early tax proposals and other things are going to be so onerous. And he might just add a modicum of stability, which should help things more so than a lot of the negatives. So I think we're looking at all these macro issues, thinking none of them alone can make an investment, and think that over the next 15 months, we should probably see a strongly accelerating and healthy economy.
That's interesting. And the data points that you shared are net of unemployment. I assume all the people, sadly, are unemployed right now. It's net of all that.
Net. So consumer incomes, inclusive of unemployment, have accelerated. Now that's waned a little bit. So the government transfer payments were more than what people would have otherwise earned, and their spending was restricted. So you had this big buildup in savings. which I think is going to portend well to consumer spending, consumer credit trends, and a number of areas that will be kind of and we would expect if you get a Biden victory with a Democratic Senate that you'll get another stimulus package, which will push that even further. So pretty healthy consumer, which is 70% of the economy.
Interesting. Morris, want to take a shot at telling us how these macro important issues are affecting your investing?
Ricky and I have the same heritage, and we're basically bottom-up investors. So we deal with macro as a factor in trying to protect ourselves. Also, we try not to predict. We look at probabilities, but we want to be prepared for whatever outcome happens. So the things that are influencing us right now are the fact that I can't predict the election. I'm not going to try, but I do know one thing. The one thing that the market can't get prepared for is an uncertain outcome, something which goes to attacking the roots of the system. I think that's a reason to have some protection today. And I think we'll know sometime between Election Day and the meeting of the Electoral College on December 14th who the next president's going to be. I'm not encouraged by that behavior of the administration with regard to its respect for our system. But that's not a value judgment. That's an investor being concerned about an uncertainty that is completely difficult to predict and hard to prepare for. The other thing, I totally agree with Ricky. The economy is getting better. It's sort of disjointed because certain segments can't participate, and certain segments are doing very, very well, and I would expect them to continue to do so. So that raises two issues. The other variable is how long does the Fed continue to provide stimulus? They're saying for a long time. And that's the engine for the framework right now. There is no fiscal engine. Stimulus is not an engine, it's a redistribution. So I think that's one thing. I think the other factor is probabilities, not certainties. That's the whole thing. It's never certain. The probabilities are improving that there will be solutions to the health crisis, both in the forms of treatment. Regeneron just sort of demonstrated that in spades, and vaccines. We need both. When we have both, we will be in a much better place. So we've been looking at businesses that we had previously either shorted or had a minimal participation in to establish new positions, looking for companies that are solid, that are attractively valued, and that really have a great opportunity to build long-term value in what we would call a more normal economy.
I was curious, you talked about having some protection. What types of protection you talking about? You talking about cash? You talking about short positions? You talking about other kinds of volatility trades? How does one protect themselves in this environment?
Okay, we tend to be investors, so we try not to disturb the investments that we think are great. We've got some investments that we own today that go back to 2008, and they're still very important to us. But what we've done is, yes, we've added somewhat moderately to liquidity, and we'll just see what we are or not willing to do with it sometime after Election Day. We maintain a moderately above normal equity market hedge position. And there's a lot of disjointment in terms of trying to figure out whether stocks are cheap or expensive. But I'm sort of old school. And old school is you used to look at the value of equities against the value of risk-free assets. The problem is risk-free assets today are extremely generously valued. They trade at about 70 times earnings with no growth potential. They're not supposed to have any. So the disparity in relative value where the equity market in relation to risk-free assets is cheap, okay, is that we have to consider protecting equity values by having some measure of protection against the so-called risk-free assets. Sounds like a non sequitur, but it really isn't.
Thank you. Panayiotis, you're an allocator. I'm curious your take on the macro environment and how it influences you.
Sure. Thank you, Gregory, and thank you to the Milken Institute for inviting me to be part of this esteemed panel. Overall, at the trust level, we try not to take macro bets or macro views. We have an asset allocation exercise that we go through every 2 years, at which point we set our asset allocation bands, if you will, by asset class and investment conduits. Those ranges give us the opportunity, one, not to have any knee-jerk reactions or emotional reactions to everything that happens in the market. And things happen in the market at high speed today, or it seems that they do. Second, they act as a natural speed bump and give us the opportunity to be tactical orienters within long-term investment points of view. At the hedge fund level within the trust, speaking of protection, our main portfolio is supposed to act and serve as a risk mitigator to the rest of the trust. That is by design. And so what we have done in the long term is seek strategies and asset classes that we believe will benefit from greater volatility, greater dispersion in moments like we had in February and March or in this past September. So we do look at relative value strategies. We look at long short strategies with a healthy attribution on the short side of the portfolio. That we look at strategies that have positive convexity that can benefit from increased volatility that we believe was due to increase as we entered 2020. We didn't have the pandemic or killer hornets or social unrest as our catalyst for this increased volatility, but we felt that it was due to increase and be more persistently elevated. And so that's how we design our book, is to benefit and serve as a natural hedge simply by being exposed to these type of strategies. And that's how we look at our allocation. It's how we avoid making macro bets that, to Ricky's point, in the long term, short-term noise. You can only ask so many opinions, but that's what they are, opinions and predictions. You become a pundit and you just simply move on and look for the opportunities, good or bad, as a result of what's going on at the macro level.
Interesting. Let's shift gears a little bit. I'm going to turn to Mala for this one. The Robinhood type trader is really having an impact, or seems to be having an impact, if you read the morning newspapers, as we all should. But maybe we are overdoing it here in the media. Tell me how important these sort of retail investors are. Have they impacted the market, and how does it change you, if at all, as an investor?
Yeah, so it's interesting because if you look at overall percentage of flows in the market, retail flows have climbed from about 10% or so of the U.S. market to 20% or so today, right? And we know that these investors are thinking more about momentum factors, and they're very active in the options market as well. So you would expect, and you do see in certain cases, particularly in the small cap realm, a disproportionate impact. But taking a step back, what's interesting about this is you really see probably a much more limited and focused impact. What's interesting is if you look at, until August, Robinhood would sort of actually disclose more account details. If you can actually look at the names, where it's been in the trailing past 5 days, there's been the largest number of Robinhood accounts opening and percentage of ownership that's Robinhood related. And if it's interesting, you look at those names, there's a run up, sure, ahead of the retail investment run in. But then it fades, and it fades to really kind of market levels of performance. There isn't really any significant outperformance after that. What's also interesting, to the point about a focused set of names in narrower time frame in terms of impact, so I think it's relatively temporary, is you see the mean impact is very different from the median impact, right? Because you sort of see very small number of names who've had parabolic performance, like the Kodaks of the world or the Candy Technologies of the world. And other than that, for the larger cap names, it's been a little more muted. So we look at it, there are interesting opportunities, obviously, on the short side here that present themselves. But I think the impact is relatively focused and moderate in terms of duration.
I'm curious, is there an example that you can share of maybe one where you guys put on a short where you thought this does not make sense, retail is getting carried away here, and you made some money on that?
I mean, I think there have been a range of, there've been a range of sort of stocks that have obviously benefited from Robinhood impact, but in terms of very specific names that have had big outsized impact, I mean, I think we've talked about some of them. There's also been names such as the Nicholas of the world, right, that have been impacted by this. So there's been a lot of speculation out there that we can focus and target on, but I think it's very ad hoc, Greg, and I don't think it's something that's a broad phenomenon that we can all take advantage of, like very different from say 1999.
Thank you. Ricky, want to kind of share your perspective on the Robinhood investors?
Look, I agree with a lot of what Mala had to say, and I think they are having an outsized impact on a small number of names. I think they're extending a lot of the momentum. Some of those companies are doing well, and shorting them presents a bit of a timing challenge. But I would say, broadly, kind of betting against the retail investor being successful here is something that we are looking at and looking for. I'd rather not share any specific short positions publicly, but we do think that there's a meaningful impact in a small subset of names and is creating excess momentum on top of things that already have a fair bit of momentum and creating some interesting setups where one has to be careful on managing position size because they can continue to go up, but interesting over the next 12 to 18 months.
Is there an example, Ricky, where there was an opportunity created? In other words, retail got all nervous and scared and dumped some position and you jumped in?
I on a day-to-day basis, you can't tell exactly who's acting. So there's been a lot of volatility, a lot of individual stock volatility both ways. And we're long-term investors, and we will take advantage of those things when they're the right business at the right price on both sides.
Okay. Let's turn to maybe one of the most debated topics in the world of hedge funds. It's growth versus value. How long will growth stocks outperform? Is there an opportunity here to get into cheap value? Should one be kind of shifting even at the margin? Panayiotis, why don't we start with you? Give me your perspective in terms of when you talk to investors as you allocate. What are you thinking about the growth versus value debate?
Sure. I think at the high level, when we are able to find managers that have been successful that have a value-oriented bent, they tend to be managers that focus on value, but is value with a catalyst. And that tends to be a more successful strategy overall. Couple that with perhaps elevated leverage or concentration. All those three elements tend to contribute to attractive returns for value-oriented strategies. At the high level, if I personally look at some observations going back, say, 20 years or so, we saw that value outperformed in the mid-2000s, leading up to the last financial crisis. It underperformed, obviously, during the crisis as the economy entered into a recession, kept pace a little bit coming out of that recession, and has lagged, as we have seen since that time. The common denominator through those observations is growth, economic growth. So you can view it value either as a contrarian play if you believe that we are to enter a new sustained economic cycle, as Ricky seems to suggest at some level, or unless there's a delay to that recovery due to a double recession. Or you can look at short-term, a couple tailwinds that seem to be present in the market. One is the fiscal angle. If there is a big fiscal announcement, that should boost near-term economic growth, which should favor value stocks over growth. If you're a growth-oriented company in this environment, you're already doing well, whether it's for some reason, whether you have pricing power, you're capturing market share, you're a beneficiary of certain COVID-related themes, whether it's work from home or new industries that are being created. So if you're already growing, I don't think there's that much more growth or impact from a fiscal package compared to value stocks. The second is corporate tax reforms. We know that if there's a change in administration, it's a foregone conclusion that taxes will most likely increase at the corporate level, whereas in the past they were around 29% at the effective tax level. They decreased down to 20. However, many growth-oriented companies like biotech, IT, have an advantage when it comes to both onshore and offshore effective tax rates. Should those tax rates converge, perhaps that will be a headwind for those earnings on growth-oriented companies, which again might benefit their value counterparts. I'm not a tax expert, but perhaps that's something to keep in mind. And lastly, when we're talking about growth, we're talking about tech and software in the big five a lot. It seems that there's increased chatter when it comes to antitrust matters, perhaps regulation, and seems to be gaining bipartisan support for a closer look at that issue. And that, again, could affect growth-oriented companies. For example, growth-oriented companies make a big part of the MSCI Growth Index if you're looking for benchmark relative impact. So those are some views on value growth.
Interesting. So it sounds like somebody who just buys cheap stocks, a value, traditional kind of value investor, is of less interest to you. There needs to be some catalyst, just given the slump, I guess, or the years-long slump for these guys.
I would say it's of less interest. It's just an observation. As you imagine, we see thousands of managers each year, and we're trying to find points of differentiation between strategies and approaches and processes. And more often than not, in an environment where value has been out of favor, value with a catalyst, having a different type of bend, a certain type of certainty of outcome, cash flow visibility tends to do a little bit better. But you have to marry that with other portfolio management decisions, such as leverage or perhaps concentration.
Interesting. Morris, care to weigh in on the value versus growth debate?
It's funny, we consider ourselves to be value investors, but in the sense that the value of every commercial asset is the discounted value of its future cash flow. A bank could be cheap if it was trading at 8 times earnings and there was no growth because it would be giving you, but it was consistent. It would be giving you a 12% rate of return. We have found that the best value are companies that have the capability to build value, companies that have the capability to compound their rate of return. We are really interested in valuation. We studied Graham and Dodd. We've got our CFA. And we're always looking for companies that are trading at book or at discount to book, but they need to show something that would indicate that that does not reflect their value and their future value. And the funny thing is, what we are buying are businesses. And the people that are running those businesses are really important. A change in CEO, a change in philosophy, a recognition that what you thought was cheap isn't, because it's going to be legislated out of existence. All of those things are important. So, we're really seriously interested in value. And we look at valuation as a guideline. We may have some really great positions, we hope we do, in some terrific businesses, but as the multiple expands, then we've got to see whether the valuation has gotten too far ahead of where we believe the earnings will be, and we try to take that into account and the discount that we apply to that earnings stream. So I know that's a sort of a half blank answer, but I'll be more specific without naming names. There are broad sectors of the economy today where you can find a lot of low multiple names. And they don't look that different until you look a little harder. And you'll see within those sectors, financial services is a great example. There's dramatic structural change occurring, both geopolitically and technologically. And there are businesses that are trading at the same multiple with very, very different prospects.
Thank you. Amala, care to weigh in?
Yes, I think we look at value in the sense of what is the best risk reward versus growth, right? And so from that perspective, the traditional hunting grounds, the earlier points made, the earlier hunting grounds are just saying, okay, we just look at a set P multiple and set cyclicals. I think is a little dangerous. I mean, I would actually argue the value that we're seeing in, say, something like just to be very specific and give all of you an example, something like a Facebook at sort of low 20s forward multiple versus, say, some of the packaged goods companies that are trading at more like high 20s multiples is just harder to see for me. And if I actually look at the cyclicals looking forwards, COVID has actually changed the dynamics, obviously, on the macro context, as we discussed earlier as well. So cyclicals have seen the biggest, decrease in earnings estimates. IT is obviously the largest growth in EPS estimates. Now, that might not continue forever. One has to look at regulatory factors, as mentioned earlier as well. But I would argue that some of the growth sectors actually look like very good value if you actually believe in the duration of growth that's been pulled forward by COVID-19 and the respective push that has given to certain areas of tech. And we're seeing that across the board, not just in the US. So I think that's something I would just point out.
Interesting. Thank you. Ricky, care to weigh in?
Yeah, sure. I think this is a very hotly debated topic, and I think there's a lot of nuance to it that people need to appreciate, which is that there are a lot of really interesting growth companies, and there are a lot of value companies that are being disrupted and are value traps and uninteresting. Having said that, and this may be unpopular with my panelists because they're two of the best growth investors on the planet, I do think we're setting up for what should be a rotation in the market. Not only have we reached very extreme levels of valuation disparity between, let's say, companies that grow quickly and companies that grow slowly. If you look back since the 1999 bubble, growth companies have tended to trade at 2 to 3 times the multiple on 2-year out earnings as their value counterpart. So we're giving them some benefit for growth. That 2 to 3 has climbed to almost 7. So you're paying 7 times the multiple for these companies. And the only time it was higher was 1999. So you have a good setup on value, but that alone isn't enough. I think you also have factors that should help, which is the acceleration of the economy, the reopening of things, the things that Mala talked about, the companies that saw the biggest decline in earnings are seeing earnings start to recover back. And so I think that ought to also create a catalyst for the money to start shifting. And then lastly, I do think there are some issues looming around big tech. And the big tech companies are all fine, terrific companies, and not particularly overvalued stocks. Some of them are quite reasonably valued. But when you look at the movie Social Dilemma, the House Judiciary Committee report on big tech and antitrust, when you look out a year from now and realize that individual tax rates, probably capital gains goes away and people might start locking in gains and things that are up a lot, I think there are some growing headwinds that could also help this rotation. So I do expect over the next 3 to 12 months to start to see a lot better relative performance from companies traditionally thought of as more value and relative to companies traditionally thought of as growth.
So I have to ask you, give me an example. Give me some value kind of stock that maybe is overlooked, but in this new kind of environment you're predicting might become more popular.
So I think Morris mentioned the financials, and I agree in the right places, financials that are not necessarily heavily rate sensitive. So Morgan Stanley is a fantastic franchise, gaining market share, leader in both the capital markets business and now the wealth management business with the acquisition of E-Trade and InvestCorp. So asset management and wealth management are going to be 60% of the company, and a strong capital markets franchise the other 40. That company trades at somewhere between 8 to 10 times what they're going to earn. They earned a big number last quarter. They'll probably put up a good print tomorrow. They're doing really well, and the stock is probably sub 10 times normalized earnings with a terrific franchise. So I think that's a good example in financials of overlooked value.
Interesting. Which is a nice segue to our next topic, sort of what innovations you each find exciting and interesting. And before we get into that, let me just tell everybody listening along, watching along, to encourage you to send along questions. We'll get to them at the end. We're going to leave some time already has been one really interesting question, which I'm looking forward to sharing with the panel, but I encourage others. So why don't Panayiotis tell me kind of what sectors, what areas of interest, what innovations excites you? Maybe it could be types of funds that you're allocating to. Kind of what impresses you? What meetings have you had that you've come away really kind of learning something and kind of struck by what's happening in the economy?
So aside from a new vaccine, which I think all of us are looking forward to, I think one new frontier that I think it will pick up some more steam is the digitalization of currencies. That may make some Bitcoin fans out there excited. I'm not sure, but I tie it again back to technology, and we've seen, especially with the pandemic, that technology and innovation are changing the way that we consume, work, and relate with each other. This is a perfect example as we're talking today. Obviously, technology has become more imperative and ingrained in our lives. And if there is additional proof needed that we are headed down this pathway, I would point to an announcement by the ECB that was made in the beginning of this month, where the bank has actually put a commission together to look at possibly adopting a digital euro currency. Of course, we're far away from all of this becoming a reality. And we also have to keep in mind that when we're speaking about the value of money, whether it's in the traditional form of paper and coins or digital forms, it all comes down to citizens and consumer trust in deploying these currencies. But I think that's going to be the new frontier of how we interact, how we consume, and it's going to affect consumer behavior, world trade, the role banks play in our ecosystem. So that's one area. Obviously, everyone's talking about 5G. We saw the announcement yesterday by Apple and iPhone 12 that it's going to be 5G. It's going to be interesting to see how technology companies utilize this new technology or higher speed. And lastly, when I think of innovation from an allocator's perspective, I connect it to another topic that's been much discussed this year, which is impact investing. And I think impact investing is here to stay. It still needs to develop and quantify its value in portfolios. But I think it is here to stay. When I think of impact investing and I think of innovative managers, I think of innovative strategies that try to exploit this new frontier of investing. And that perhaps even leads to new managers coming out and putting firms together, which may favor emerging managers versus established managers. And so that's how I think of innovation in that sense as I tie it back to strategies.
Interesting. Thank you. Mala, kind of want to share your thoughts?
Yeah, I think in addition to, what was just said, I would put it into probably two big buckets. So there's the whole area around just how data is being used. So I think data for just smarter targeting, and we're seeing that with just better targeted medicines. We're seeing that with the ability that we've had to at least speed up the vaccine development process. We see better targeting and just better credit underwriting with everything from, ANT to Afterpay. There's also data around process automation. So one thing that I think is really highlighted, that COVID has really highlighted in the lockdown, is the need for small and medium businesses to have access to the kind of process automation that larger enterprises have had, and to access the kind of productivity benefits that software services allowed. So if I think of sort of what a HubSpot or Freshworks does for a small business's productivity, I think that's an area that we see a lot of innovation happening. And I could go on and on, but data around process automation, I think, is really quite early. I think we're also seeing through the pandemic, so that's data. And I think the other second big bucket is really around new formats. For the consumer, I would say what we're seeing in China around live streaming, and the rise of sort of new sort of virtual universes. I don't know if any of you have followed what's happening with Roblox, which has essentially doubled the monthly average users, now 180 million monthly average users, 3 billion hours spent a month. But people's engagement in sort of virtual worlds online and how that's changing how we all interact as a society. I think that's something that we spend a lot of time on. We're seeing that with respect to even things like Match Group. and the innovation around, just even dating apps. And I think there are new formats in enterprise finally. I mean, I think the whole idea around how we managed. What's that?
I'm sorry, what are roadblocks?
Roblox, ROBLOX, is the one of the largest platforms out there for gaming, and it's primarily under 14-year-olds. It's about 50 million games. It's a virtual world that you go on. You're given the tools as a developer. There are about 1 million developers who use it to build games for the users, the 180 million monthly average users that I mentioned. And I engage as a game player with those developers, all online. All the revenue, there are no advertising revenues. All the revenues are really from purchasing skins, virtual items online. And it's a very robust, innovative world. It's being used for game developers and game users to interact in essentially virtual economies, develop games, test things out, see if my game will work or not. When I develop it as a young developer or not. And so I think those are the kind of really interesting, immersive, virtual worlds that are emerging out there, whether it's Fortnite or Minecraft, which Microsoft bought, or Roblox. I think these are the kinds of formats that are emerging that are really worth monitoring and having a sense of. And then finally with enterprises as well. I mean, you're seeing just a rush of live data streaming that needs to be managed and monitored. And, we've been investing in companies like Confluent and Snowflake that help that process work. And I think being at the cutting, at the bleeding edge of that is something that we spend a lot of time and energy on. So I think those are the two areas, sort of new formats for both consumers and enterprises, as well as new data analytical points.
That's fascinating. All right. We're going to shift to Morris. Care to share some thoughts, Morris, about what's the most innovative area you're seeing in your world?
We've been involved in interactive gaming as an emerging worldwide phenomenon for some time. I think Mala touched on it in a different way. But I think we want to also approach this differently, both in terms of historically and what we're looking at right now. It's hard to predict innovation, but you can find really bright people to invest with who innovate, whether that historically was the late, great Steve Jobs, or right now, somebody like Mark Zuckerberg, who is smart enough to buy it when he finds it and is smart enough to invest in it, to develop it. When he talked about creating a digital currency politically, because of some of the regulatory factors that Ricky mentioned, he wasn't able to implement that. But he knows where things are going. And there's no accident that he invested, I think it was $5 billion in Reliance Industries in India to really develop a base for developing a payment fabric for WhatsApp. So I think you want innovative people. Amazon started out as an online bookstore, and now it's the largest and most important technological service company in the world, the notable exception possibly of Microsoft. And that just came out of Jeff Bezos' head. I remember a conversation that I had, and he said, this centralized web servicing that we have, they didn't call it the cloud-based. It's going to be bigger than the retail. And it may or may not be, because they're both pretty phenomenal. So you want to look for innovative people. Elon Musk is an innovative person, whether he has the discipline to focus enough, I don't know. But I recall the comments of one investor who said that Tesla was the least complacent company he's ever followed. And they're working on battery technology. They developed solar roofs as opposed to just solar panels. So there's a lot of things that you want to look at. You want to look at bright people. They're innovative. Strauss Zelnick at Take-Two, he knows he's in the entertainment business, and he works hard to create great interactive entertainment. So those are the kinds of things we think at. Look for people, look for innovative businesses, and look for innovative technologies. And just on that last point, everybody's saying they're looking at technology companies. I remember a line that Steve Jobs once said at a meeting. He said, without technology, we'd be people in a cave talking to each other. Cars, internal combustion engines, that's technology. But it looks like they're going to be replaced by electric motors. Okay? So it's digital technology which is changing the world. And digital technology means more than just the 6 companies that Ricky is worried about regulating. We can discuss that at another time. But it means restaurant companies that put in drive-thrus, okay, using digital technology, okay. It means the New York Times completely transforming its business to an online journalism company. Printing presses are still important to the Times because, we live in New York City or the metropolitan area, and we like that hard copy. We're old fashioned, but I get my morning news basically online. Okay, so I'm just saying we've been looking at digital technology as a transformative event, and it's been a very, very, and will continue to be very important in terms of what we want to invest in. Hope that answers your question.
Looks like just the 4 of us. Maybe Greg was disconnected.
I think you're right, Ricky.
We can have a little idea there.
Free for all.
Yeah.
I guess it's your turn for innovation.
Okay. We can have a whole discussion on innovation. Innovation works both ways. We'll just say this, there are business models that I'll bet Ricky's short on, and looking for alpha shorts. If you're looking for alpha shorts, you basically look for business models that haven't adjusted or simply in a roadblock the wrong way to what's happening. So companies that aren't innovating or can't innovate their way out of things or don't have the management, that mindset, are used to going to government to protect them, may find it just doesn't work. Just leave it at that.
Yeah, I think I was just thinking about, Ricky, what you raised as well with respect to the factor rotation risk, and I think that's a significant point and something we talk about a lot. On the other hand, I also just think about the other risks out there, right? Which is just, what if, vaccine, therapy, economic growth don't go according to plan, right? We've had, 2 out of the 4 phase 3 kind of vaccine trials halt. We've had it temporarily, hopefully, and we've had therapeutic trials halted. 43% of Americans say don't even want to take the vaccine. So, there could be other roadblocks in the way, and I sort of think secular growth is what I'm good at. So the duration, if I look out 2, 3, maybe a year or 2, factors dominate. But if I look out 3 to 5 years, I sort of think ultimately longer term growth drivers will prevail and more fundamental factors usually prevail. So if that's the case, how can I really balance, or how can I have as much assurance on some of the value rotation kind of persisting? So I think that's something worth discussing too. I don't know what you think there, Ricky, but that was.
Well, I think those are great points, and I agree that there are many reasonably valued to interesting growth companies, and so I don't maybe think it's as broad as what existed in 1990 or 2000. But I do think that there is, quite frankly, a lot of companies that are not actually being disrupted at all, but don't fit into the camp of super high growth or steady Eddie bond proxy, that have kind of been left behind in the market, and have quite strong businesses. So I don't think there's a black and white answer per se, yeah. and we own a number of growth companies that, in our top 10 as well. So, but I think as a broad measure, the excitement with open-ended TAM and open-ended growth has created a lot of, or quite a number of very, very large market caps that seem like they need enormous multiples of growth from here to kind of grow into that. And I know that time is your friend there, but it seems like your growth investors are pulling forward. While some businesses have pulled forward earnings with COVID, I think investors have pulled forward even many more years of growth, and sort of pricing those in as more certain today than they have in the past. And that may not be completely wrong. So I respect your viewpoints there.
Yeah.
Ricky.
Yeah. To your latter point, Ricky, there was actually a report by the Bank of International Settlements that was released maybe a month ago. And basically what they did was to try and figure out what impact monetary policy has had in this run up, both at the valuation level and earnings, but also what the market has been valuing. And to your point, what they did was look at dividend futures for the S&P and Eurostoxx 50, and they looked between today and 2024. And what they found was that the futures in 2024 actually rose more than they did in near term, despite the global anemic economic outlook as it looks today. So they were trying to make the point that investors seem to be placing a lot of value on the visibility of cash as far out as 2024, despite everything that's going on today. But if you marry that with lower rates today, that justifies the higher valuation. But they've quantified that without rates coming down as far as they have, valuations and earnings will probably be worth about 50% less than they are today. And to your point of about valuing visible cash even 4 years out with so much uncertainty being present today.
Yeah, and I think the interest rate argument is an interesting one for growth companies. I think it's interesting that that argument has only applied to growth companies, meaning the multiple on other businesses, which, as Morris pointed out, should be worth more at a lower risk-free rate, haven't necessarily re-rated. So it's been a very concentrated re-rating of the market here in what I would say are the big five, which are terrific companies, and I don't have anything against them. I guess I don't own any of them today, which by definition makes me, if they're 25% of the market. Actually, we have a small position in Amazon, and then the fastest growing companies, and those two have made up all of the multiple expansion in the market and then some. From what we've seen, which goes to one of Greg's questions, which is there's a lot of still interesting businesses out there outside of those two camps, and maybe even in those two camps.
There are a lot of companies in the S&P that have not been able to perform economically. Airlines, for example, obvious examples. But if they're in the S&P, they're expanding the multiple. Conversely, I'm not sure that Facebook, just using that as an example, because it's probably one that is ripe for areas of re-regulation, has had a significant expansion in its multiple at all. So that you can't say it's the big cap stocks like that have resulted in the expansion of the market multiple. What you can say is because they have been growing and aside from regulatory issues, increasing in value, they've gotten to be a bigger share of the market. But they haven't really expanded the multiple. Their multiple has been pretty consistent. It's just that a lot of other businesses that are really challenged now aren't making any money.
I mean, I would say that Microsoft and Apple have seen very big multiple expansion over the last couple of years. Facebook kind of saw some multiple compression around its issues maybe 2 years ago, and that's expanded back. And Google's had sort of a consistent multiple. But yeah, I don't think that they're too expensive for their prospects. I think those companies are all doing well. But at least in the case of Microsoft and Apple, you've seen, I think, meaningful multiple expansion over the last this year and maybe the year before.
Hey guys, why don't we?
Parenthetical comment: Apple just proved that Warren Buffett is still a great investor.
Despite the investment in the Japanese trading firms, he's done unbelievably well with Apple. Why don't we shift to some of the questions that the audience has shared with us? One of them was really interesting in this environment, and I'll start with Panayiotis. It's hard to get in front of managers to directly interrogate them, interview them, discuss topics. How do you do due diligence? And then others in the panel, I'd love to hear as well. How do you do due diligence in this new crazy pandemic world of ours?
Yeah, I mean, similar to everybody else, we've been working from home for the better part of the last 6 to 7 months, and it's been a lot of phone calls, a lot of video chats. Actually, our workload seems to have increased, perhaps because everybody is home and not spending a lot of time at airports and traveling, and it's easier to connect for 30 to 45 minutes. But I could easily have video chats and update calls 7 days a week, all day long with managers that want to connect. And that's been the short-term fix for everybody while we wait to see what next week brings, what 2 weeks brings. We view this as a temporary change. I'm of the belief that as much as video chats have become the norm today, I just don't see how it replaces an in-person meeting, on-site visit. I truly believe that all it's going to take is that first fraud. And when there's a post-mortem and someone asks what happened, and they say, well, we did our entire process virtually, that should be the end of that, regardless of what you think you saw on the other side. At the end of the day, we're a people's business. We need to assess whether or not we can enter into a partnership with somebody, read those soft skills, read body language, read tone. As we can see today, even with the best technology and best intention, things happen and interrupt. I just think that when it comes to due diligence, technology, like everything else, will become an augmentation of our entire process. Perhaps managers start building more data rooms to provide videos and video chats of the process and humanize the process in DDQ. Perhaps instead of 2 or 3 interface meetings, we're down to 1 because we have had a number of video calls. But overall, right now, from our end, we've made an audible of basically going with the flow and dealing with what we have to deal with. But I just don't see how we revert to a complete online due diligence process. Maybe I'm biased, maybe I'm wishful, but I think it's going to revert back to some sense of what we had pre-pandemic.
That's interesting. And Ricky, you run a firm. How much of this new world stays with us after we, God willing, have vaccines and get back to some semblance of normalcy? What have you learned? What kind of things can you take from this new world into the next one potentially?
Well, I think it's pretty clear that business travel is going to be permanently smaller. I think we've all figured out that some amount of our travel can be replaced with Zoom and video conferencing type things. In fact, some of our phone calls should have been moved to that. And if I look in the past, probably half of our conference calls should be video and half of our meetings should be video. And then the balance will still be, we still want to go visit companies. We still want to sit across the table from management teams and kind of get body language and perspective and make connections with people and do our field work. But I think for sure we've all found a significant amount of productivity in not having to, in less commuting and in less travel. And I think some real part of that stays with us.
And you're okay with your employees working from home some percentage of the week in a year or two?
Yes, I think we're trying to create a hybrid approach where our important meetings are 3 days a week, and people can have flexibility to work from home other days. And so I'd like everyone to get back in person and collaborate. I think we're fine on video. We're good on video, but we're better and at our best when we can collaborate. So some hybrid of that, I think, is what we're thinking.
Interesting. Mala, you want to weigh in on this one?
Yeah, it's interesting. I mean, from a maybe company perspective, talking to a lot of CIOs out there, they say that productivity for existing projects, I'm talking mostly about, software, but broadly, existing projects and existing, people in the organization, it's working okay. But for new people coming into the organization and new product ideas, there's a problem. Because I think having that sort of just synergy of people getting together around a table, to the earlier points made, is just different. So I think that's something that we will still all have to figure out. And I think, as Ricky said, it'll probably be more of a hybrid approach where you sort of think about new products, new processes, new people being the focus of in-person meetings, with everything else probably more from afar.
What's the one stock to buy then? If you believe in this hybrid approach, which it sounds like the panel is suggesting that's our future, is other than Zoom, is there some overlooked stock that's a way to play that trend? Morris, you've got a thought?
I think some things, if you're right, uh, can be pretty obvious, and if it doesn't work, I'll apologize. But something like Disney, here's a company that just announced this week that it's going to really emphasize streaming. Maybe it won't deliver. If it doesn't deliver, that's going to foreclose a long-term opportunity and maybe create a long-term issue. But if they do deliver, they're sitting with all these assets that people have not been able to get to. You know, I mean, Disney World in Florida is probably the single most attractive family vacation site in the world. And it ain't making any money right now. Now, if you look at Disney, for example, just using traditional security analysis, 50% of its EBITDA basically came from the parks business.
Wow.
When and if we can travel with safety and go with our kids and maybe our grandkids places like that, and it has some pretty special places, that's going to be really important. And if you look at that in a world of low interest rates, particularly in a world where real estate values have just been messed up because maybe we won't need quite as much office space as quickly. I agree with everybody's previous comments. We certainly don't need as much retail space. We weren't going to need it anyway before this happened. This just accelerated the process. But if you own all the real estate under your parks and you have an income stream that is extremely valuable, you could capitalize that today, I think, to a pension fund investor of real estate at a 3% yield with some growth built in of a percentage of the growth, let's just say the revenues of the rentals. That's a lot higher multiple than most people would put on that business. So I use that because there's some obvious names that when and if things get more normal, that have the financial capability, the franchises, and apparently the management. That's my big question right now. To really put something together, or I just put it in simple terms. Vegas is always going to be Vegas.
Okay. We have 3 minutes. So, and we have a question or two that I wanted to try to address, and I'm going to wrap it into one kind of rapid fire question. Can hedge funds compete? And we're talking about, can they compete with 60-40 funds? Can they compete with quants? And someone had asked about alternative data. How are you guys kind of adjusting the way you operate given this world where quantity type investors really a lot of AUM is going to those types of investors? Give me your sense of how you're adjusting to this new world, and are you incorporating alternative data? Ricky, you want to start us off?
Sure. I guess I'm a believer that man plus machine is going to be better than man alone or machine alone. And we've been using some of these tools as tools for our bottoms-up analysis, the alternative data. And we built out a data science effort to help us and augment us. It is not driving our investment decisions, but it is a piece of our process. We're using Quant to help us understand the impacts of our portfolio and our factors more broadly. But from I would say that computers cannot replace human judgment and understand human emotion as well as humans do. And the market is definitely made up of human emotion. And I think a combination of bottoms up that uses these tools is going to be required to succeed.
All right, we have 1 minute left. Amala, I'm going to give you the last word.
Look, I think I'd echo what Ricky said, but I'd also add, like, quant funds also, it's just hard for them to scale their traditional, at least, processes. So they're increasingly looked at the same fundamental data that we all look at here in this group. And I think we look forwards as opposed to backwards. Fundamentally, quant algorithms have to look backwards, just the nature of machine learning being what it is. And we have to look around corners and look ahead. So I'd end on that.
Wow, that gave us 30 seconds. Panayiotis, you want to weigh in for a quick thought?
I think in a low rate environment, I know there's been a lot of discussion about the 60-40 model and where return is going to come from. Your fixed income portion, which is fixed but not a lot of income. I think alternatives will start playing a bigger role in those portfolios to replace a certain part of your bond exposure, whether it's a proxy or a complete alternative.
Wow. Well, Morris, you only have 3 seconds, so I don't want to Yeah, well, I think we're done. So thank you for everyone, and thanks for the Milken folks for making this happen. Never thought we would have to do this from our homes, but in some ways there's a advantage so we can communicate maybe to more people. And I'm sure I just want to thank everyone on the panel, all super smart, interesting investors with different approaches. So I want to thank everybody for taking the time. And stay well and be well.
Thanks, Greg.